9, 6, 9, 8, 9, 10 are just kind of miscellaneous follow-up, kind of mop-up items to the income statement. So this chapter is really about income type items and also introduces the cash flow statement. But in these three problems, 9, 6 and 9, 8, and we're going to be talking about revenue recognition. We're going to be talking about overstatement or understatement of inventories. And we're going to talk about getting a target price for our product. Okay, and these three particular problems. So let me start here with 9-6, guys. We got a company here, a theater company, who's selling 6 events, right? And those events are a price of $240. But they have this kind of an event that they start out with that is gonna be more expensive than the others. So they're going to basically allocate more to that event than they are the other 5. Okay. So they've come up with an amount of $60 here. I have it here changed in red so you'll focus on that. And then they ask you, okay, well, how much revenue are you going to earn then after 3 events? Okay. And so this is all pending, guys, when they have an auditor come in, and the auditor will check to see whether or not the first program's event is in fact worth a reasonable estimate of it. Is it worth recording more than the other events? Okay, so and they'll decide that. But let's say that they do decide to do that. So we take the first event here, I have it in red, and the next 2, and we get a total of $132. And we multiply that times our 1,800 ticket holders, then we're going to, remember, we're going to have earned revenue from these 3 events of 237,600, right? Now we then would have then an amount of money that is the other 3 events times 3, okay? 36 times 3 times these 1,800s would be in an unearned revenue account, would be in a liability account. Then at the end of an accounting period, if an end of an accounting period happens after the 3rd event, okay? So the point is, though, is what's irrelevant to the revenue recognition process, right, is the fact that we got the money. The relevancy is, did the critical event take place? Did you actually give that performance that you promised? Was the amount that you are allocating for it for revenue, was it reasonable? And how much revenue did you recognize? Okay. So if they had a fiscal year that ended on June 30th and they had their 3 events, spring events done already, and then they still have 3 more events, then they could close out their record and have $237,600 worth of revenue to record, okay, to take out of unearned and put into earned. So that's what this is kind of all about, but it's just kind of a quick calculation. And the main point of this question is that first event, is it actually more expensive to put on? And is it then reasonable to allocate more of that particular season ticket price than you would for the other events? Okay, so good management decision kind of thing. Let's scroll down here to 9, 8 here. Okay, and I want to talk about this one here. It's very, very important because it's really the only problem that touches on inventory, at least until we get to cost accounting. Okay, but the inventory here is what they're telling you is overstated. The ending inventory is overstated by $30,000. Okay, that's all they said. And this is what they're telling you. And all these numbers here, guys, are in here. When we calculate cost of goods sold, we take the beginning inventory and we add our purchases and we come up with a cost of goods available for sale. We'll do some more of this when we get to chapter 13. And then we have less ending inventory. Well, we want you to realize that counting inventory is very, very important to accountants. in that they have their own explicit standard for it. So auditors the auditors that come in from the outside are required to actually walk around with the employees of the company and make sure that ending inventory is counted correctly. Now, I'm going to tell you why that is in just a second. If you'll look here, you have an error here in ending inventory. That means that your cost of goods sold is understated by that $30,000. That means your costs are understated. That means your income is overstated. So a manipulation of inventory, guys, is very, very important. It's a good many frauds out there where this has happened, where companies would sort of overstate how much or overcount how much they have in inventory, right? And so when they do that, they'll sometimes send the auditor back through the same set of products, and they've actually been able to deceive the auditors in some ways too. So this is a very, very active thing, guys. If you can lower your costs that much, then your income is going to look better. Now, if you see here, there's a corrected column. And remember, all these numbers are assumed, and so they can show you an overstatement. And if you corrected it, look what your cost would be. It'd be $280, not $250. So that means your cost would be more and your income less. Let's prove that down here. Let's stick our cost of goods sold in here, right, of $250. But understand that that is what? Understated, right? So we corrected it here, right? What's the difference in income? $30,000. So they're kind of proving that for you here in this particular discussion. And I just want you to realize too that if you left this error alone, because the ending inventory then becomes the beginning inventory for the next year. So if you are in fact, you have no other errors, you just have this one overstatement of inventory, then the beginning inventory is going to be overstated in the next period. And then in the third year, all of that is going to wash out if you have no more overstatement or understatement. So what they're basically saying is that your net income, operating income, in this case, is going to be $30,000 less than it should be, right? No, more than it should be, in the first year. In the second year, then reverse of that would happen. So it would wash out, if you will. And that's the discussion in C right here, okay? But I just want to kind of get you to understand that that's why if management has an incentive to overstate their inventories, they can kind of control their income amounts. So that's an area of abuse that we have found as accountants, and we've tried to address that issue, okay? But we wanted to show you as an MBA student the magnitude of what would happen to income if you had an overstatement like that. Now let's scroll down to exercise 910. Okay? And this is a fun one, guys. If you have sales of 900 million here, that's 100% of your sales, and you have a gross profit percentage of 37.5. Guys, you can come up with the gross profit here, right? By just simply multiplying the 900 times the 37.5, and you're going to get your gross profit. Now remember, that's a gross profit amount, okay? But if your gross profit percentage is 37.5, then your cost of goods cost percentage is what I just call it, a cost percentage. So on your goods, your cost percentage is 62.5. Now, guys, this is what analysts look at. They look closely at that, okay? Because this is really your income statement here, the beginning of it, okay? And so there is a way of calculating what your cost was if you know what your sales were, as long as you know what your gross profit is. If you'll come down here, guys, we can go from the macrocosm to a microcosm, right? You can call it, here's macro look, micro look. What we can do is we can use the same kind of calculations and percentages to determine what a selling price should be if we want to maintain a certain gross profit percentage. So if we come down here to this problem, they tell us that we have a cost to manufacture this product, and we want to maintain that 37.5% in gross profit percentage. So if we take 62.5 and divide it into 1625, we get 2600. And then you can take that and subtract out the 1625 and get 975. Okay. Now, guys, we use this, we call this a target. We're targeting the sell it price. This is a management decision. So you can use these calculations in your business. If it's going to cost you X amount to produce this, what are we going to have to sell it for? And then we have to determine whether or not we can sell it for that amount. This is real critical stuff and good stuff. Okay, so get that out of this particular problem.